Welcome to a Wiser Retirement podcast. Before we get started with the episode, I want to tell you about a new ebook available on our website called Buyer Beware. Why do they keep trying to sell you that annuity? This ebook covers the various types of annuities, negatives to owning annuities, and better investment alternatives to annuities. To download this ebook, you can click the link in the episode notes or go to wiserinvestor.com and you'll find it at the bottom of the page. Now on to today's episode.
Welcome to the Wiser Retirement Podcast. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom today is my co-host, Brad Lyons. Hey, Brad.
Hi, Casey.
So this is a great time to talk about the 5 principles of successful investing, Brad, because did you see that CNN town hall with Trump? That's going to make you go back to your principles of investing very, very quickly, which we'll cover.
And this is perfect timing for it with the perfect information in the perfect place. I got to tell you.
I mean, I know you didn't watch that. Yeah. I didn't watch it either. Honestly, I could care less about it. But it just kind of blew up the internet. So I had to go back and watch it, which you can't find because CNN's like pretty much erased it from everywhere. But there were a couple of people who had recorded it. And so I watched it on their YouTube channel and, my gosh. I mean, talking about PTSD from the prior election. And so I started looking at, I like stats, right? So I started looking at stats. So Trump's leading the Republican primary, which hasn't even really officially started yet. DeSantis is like imploding and he hasn't even like put his foot in the race yet officially, but it's, he has like a 40% lead in the primary. And he's up in New Hampshire is where this thing took place. So if you go back in history, you look at Republican leaders at this point, when they've led by this much of a margin, they've always become the nominee. They think, okay, well, we're going to have a repeat. So then you immediately go, okay, well, what are the Democrats going to serve up? Because you got this Robert Kennedy Jr., right? That's running, which Democrats don't like. They call him a conspiracy theorist. I actually listened to the All In podcast. How do they add that to the show notes? All In podcast, where they interview Robert Kennedy Jr. You guys should listen to that podcast. It's very, very interesting. If anything, just from historical standpoint, I love history too, but just from a historical standpoint, when he talks about President Kennedy and then ultimately his dad, his
dad made Bobby Kennedy.
You're right. Who's also assassinated, I believe, in Chicago. If I remember correctly. Sirhan? I believe so. Yes.
That was in Los Angeles, I think.
Oh, that's right. Yeah. That's right. Mm-hmm. So I assume anyone gets assassinated in Chicago, but
I think it was St. Valentine's Day Massacre.
Maybe it was safer back then. I don't know. But ultimately, assuming that we're in some type of a weird recession that maybe is the soft landing that everyone is hoping for. A sitting president doesn't ever survive a recession and get reelected, historically. So you know who the Republican nominee is going to be, it seems at this point, because how could it get worse? How can the new cycle get worse for Trump? It's like nothing sticks to the guy, right? Yeah. And then you've got Biden on the other side, who apparently obviously is a sitting president who is presiding over some very difficult economic times, and you kind of marry the two stats together, and you're like, oh goodness. And then I get angry because I'm sitting there reading all this, and I'm going, why do we have to have 2 80-plus-year-old men, one who's a little crazy, and the other one who doesn't know where he is, running for president? This is the best America has to offer. I just don't understand it. It's so frustrating. And obviously I'm going to be a little selfish, but obviously it changes all of our interactions because people are so polarized by this that we have half our client base who just, well, I'll probably say half, maybe 25% of our client base who absolutely hates Trump. I think this is the worst thing ever, right? And then you have, 75% who are like, well, we can't keep going down this direction with this current administration for all these reasons. But none of that matters to your
and that being
portfolio.
the point of us bringing this up.
Yeah, it's just so frustrating that you
There's
think you're
always things that are occurring,
Yes.
okay, that are out of our control as investors. So we're going to focus on the things that are in our control as
Correct.
investors.
correct.
Right.
It's like you're not going to wake up and run your life. You're not going to go be with your grandkids or your children. You're not going to do the things you enjoy because they're in your view, the wrong political party is out there. Screw those guys. Go. This is America, man. I mean, this is what I love about this is that they can go screw up the country, but as long as you can create things and be innovative in this country and come here and live your best life without interference from them, which for the most part, I mean, unless you're in some business that's polluting lakes and rivers, yeah, you might get a little cross. If you don't pay your taxes, you might get a little cross with them. But other than that, this is the best place in the country to live. I'm talking about small business owners, I guess, in that respect. But your portfolio is the same way. Every company's woke. If you're angry about woke companies, the entire S&P 500 checks all those boxes. The bottom line is what you want that company to do is you want that company to make money.
That's right.
That's what it comes down to.
You want the free flow of capital to its highest earning potential. And nowhere else in the world do we have the free formation of capital that we have here in the United States.
Nowhere.
Right.
There's places that make it look that way, but
Right.
it's not actually happening that way.
So when we get asked questions, and we do from time to time, is the dollar going to remain the world's currency reserve? You have to
Yes.
answer it in such a way that there is no other place in the world where capital formation is as free and open as in the United States.
I'm working on that one, Brad. I've got a couple of professors that are friends of the podcast in mind, but I want to break that down because when we talk about China, and China is a facade. China's not a real economy, right? It's not a free economy. I mean, there's people there who buy things, but it's all manufactured. Their bond yields are set by the government. It's not free floating like here in the U.S.
To my point, it's not a free formation of capital.
Correct.
And where it flows to the highest purpose.
Correct. And what is their currency pegged to?
Right.
It's pegged to the U.S. dollar. That's why the U.S. government gets frustrated with the trade because they artificially peg it just below the U.S. dollar, so it benefits them. But that's what they're doing. That's why they buy so much U.S. bonds. I think they're currently selling a lot, but that's all about the float, right? Mm-hmm. All about the pegging. So ultimately, if the world were to move to trade in Chinese currency, it's still in the U.S. dollar, which that's not going to happen. It's not going to happen.
Well, the Chinese put up barriers of capital flowing out of their country. So companies that have invested over there are now currently going there, trying to figure out a way to divest themselves
Right.
and move that money to other places where
Right.
it's more free formation of capital. So it's an interesting dynamic that's occurring now. They are the second largest economy in the world, so it tends to beg the question constantly: will they ever be larger than the U.S. in an economic sense? Will they ever take over as the currency of reserve in the world? But it's not going to happen in yours and my investing lifetime.
They would have to have a currency that's free floating by itself,
right?
If you were going to eliminate U.S. dollars, and right now that currency is not free floating by itself. And if it did free float by itself, and this is where I want to get experts on this podcast about this because it gets very complicated. But it wouldn't float; it would sink, which is why, or become super volatile, and their inflation would go through the roof. So this is why, in the end, they own so much U.S. Treasuries, is because that's what their currency is tied to. Now, you could argue that there's a currency that is a modern day currency that's pegged to precious metals, such as gold, but I think that would be short lived. I don't know that you can do that long term. It doesn't quite make sense to me how you could do it in the short, small
all
vacuum.
commodities are limited in nature.
Right.
At some point in time, they will be exhausted.
Right.
It may be a long time from now, but they are limited in nature. There's
Correct.
only X amount of them. You have to find them.
Yeah.
You have to mine them. You have to refine them. And then you have to make them valuable. Okay.
And this is where the subject gets very complicated. I don't want to go much further than this.
Yeah.
But when the problem is that people take bits and pieces of all that, and then they send me emails and letters stating, hey, read this or watch this. And it can be very time consuming. I can't watch every 1 hour and a half video that someone sends me of someone I've never heard of on the internet. Right. But when I have watched, it's half truths. And then in the end, what are they pushing for?
They're trying to sell something.
Subscribe. Send me $49.95 a month for my newsletter on how to survive in a fallen America or whatever it is. They're selling fear, and they're the call to action, as they say in marketing. The call to action is to subscribe to that page and pay money, and it's just like, I've talked about this before. I remember. I read an article one time about value investing and how value is going to be the main way or the best return over the next 10 years. And I forwarded it to you and go, hey, what are we missing here? And your immediate response back to me was like, this is written by a value mutual fund manager.
I remember that.
Yeah, this is a value mutual fund manager. So of course he's going to say that, or else he wouldn't have a fund. Right.
Yeah, exactly.
So it's the whole point here is politics are going to get nasty. They're already nasty, but I don't think it's like mainstream nasty. Now it's going to get really nasty for a second round match, Biden-Trump. And I don't care how you vote. And it's going to be very polarizing. People are going to be very passionate about either side. As long as you can come to this country, create a company, you can sell your wares, you can grow a business, you can sell that business and make a fortune, which is the American dream, right? Or to work in enterprise that's stable, right? It doesn't matter. If they put capitalism on the ballot, then we have a problem. We almost did. Bernie Sanders was never he didn't like capitalism. He calls himself a socialist, right?
We almost in Russia.
Right. We almost had that election. We almost had that Sanders. You could argue that we probably should have. But Democrat Party vote has the super PACs, or not super vote, something like that.
It was the super primary in one day.
But it overwrites. Like there's a certain number of votes that overwrite other votes. So even if he got the majority, he wasn't really going to get the majority. But yeah, so the bottom line is, you don't let these people steal your joy over the next year and a half, because it's going to be a lot out there to get worked up about. Personally, I just turn it off. I could care less at this point.
I have things to do.
Yeah. Manage money, right?
I have a job to do.
Chase down all the planning changes that are going to be coming down the pike, and how clients need to be reacting to that, and
discerning when they do and when they don't.
Yeah, absolutely.
Exactly. Yeah. Because you can look at charts, and I brought one here, and we'll probably get into it at some point, but it shows major economic events over the past 20 years and how it affected the stock market. And on charts, they're little blips. It felt terrible during the time, but they're just little blips on a long-term chart.
Yep.
Okay. And these are major economic events. There are political events. There are geopolitical events. There are pandemic crises. All these things occur, but investing remains constant. Okay.
Correct.
So we're going to talk about.
So let's dive
today.
into it. 5 principles of successful investing. 1, we have to set investment goals. It's much like going through life aimlessly without having any particular interest or any particular goal in mind. It's kind of meaningless. Mm-hmm. Just throwing money into something, and the goal is to make money. I don't know that is really setting goals.
We get this question a lot, especially in our free consultations. Where somebody will call and we'll be online with them, or they'll come into the office and, we'll talk to them and they'll ask, well, what should I do with this? And the first question that we as investment professionals and financial planners always ask, what do you need the money to do for you, and when do you need that to happen?
Yeah.
We're trying to get them to set a goal. Then we can provide advice and make a recommendation. But until then, I don't know what you should do with the money. Tell me what you want it to do for you.
Right. Mm-hmm. Yeah, I look at it as like a planning checklist. The first thing you do with extra money is pay off stupid debt. So
Right.
if you have large credit cards, big interest, pay it off. Car loan, pay it off. Are we paying enough on the house to eliminate the mortgage prior to retirement? So if the answer is yes, great. We move into emergency savings. How much emergency savings? Maybe that money needs to go to emergency savings. How much money emergency savings do we need? Probably at least 6 months of expenses in an economy where you might be concerned about your job. If you're solid on your job, maybe you take it down to 3 months. But you probably have bigger expenses coming up. You need a roof at some point. You need air conditioning. You need that new car. So I would say just keep building savings. After that, then I go over to retirement. Are we saving enough for retirement? And if they are, then that's great. We check that box. What about college education for the family? Well, we've kind of got a plan for that. Great. So then the next thing, this is where it gets exciting. And this is where I think a lot of the people who meet with us who have not done that first checklist is opportunity money. And that's where people lose the goal a little bit. They're like, well, I have this extra X of dollars per month and I just don't know where it should be going. And I don't know what the purpose is. And that's where that's the fun part of the conversation for me, because I like to say, well, what are your goals and dreams?
Right.
Right. And if they don't have any specific goals or dreams they want to be saving for, then I say, great, then you can put that money in a brokerage account. And then when you do retire let's say you retire at 65, between 65 and 75, you can create a brokerage account that's going to send you almost tax-free money, depending on how tax loss harvesting goes over that time period. But you theoretically could set up an account where you have tax-free money, and then you can start converting IRA to Roth at a very low cost basis, but or a very low tax rate. That is that's what you call setting goals, is going through all that. And then a lot of times people say, I've always wanted to have a lake house, or I've always wanted to have a large place that the entire family could come and we could commune and be together over holidays. And, but I don't know what that looks like. That's what that opportunity fund's for. You put money into an opportunity fund for an opportunity that arises, right?
It's for a life event that comes along.
Yeah.
Good or bad. Good or bad. Yes. That you're prepared for it, to take advantage of it, or to mitigate, if it happens to you.
Imagine having an opportunity fund to buy a lake house, and the year is 2008, 2009.
Yeah. That's the word opportunity. The Chinese word for opportunity and the word for chaos is apparently the same. Okay. Which means that in times of tumult, opportunity exists. Okay.
Yep, absolutely.
And so that's why we have this money setting aside for when times get kind of turbulent. There are opportunities out there for people who are ready for it.
Yep. Mm-hmm. I remember one of Dave Ramsey's programs. He talked, actually it's in his book, not the millionaire book, but the older book that floats around. Anyway, doesn't matter the copy, I guess, but he's written so many. But basically, there was a lawn care guy who was over leveraged, and during the financial crisis, everyone had to, was cutting out the lawn guy pretty quick, right?
Yeah.
Or was losing their jobs. So he had to liquidate everything at a fire sale. And he was just like, look, I've lost everything. I'll have to build this back up. Dave's kind of patting him on the back. 'Cause I don't know if you know this, but in Nashville, you can go watch the Dave Ramsey show live. Now I think it's soundproof glass or something, but they have regulars that just come by evidently and hang out. And this is one of the regulars. Another guy comes in, and the next day he's like grinning ear to ear. And Dave's like, man, why are you so happy? He goes, you won't believe this, but I run our lawn care business, and I just expanded my business and bought all these great tractors and stuff at 50% off. Right? That's the guy with the opportunity fund going,
That's right.
I'm going to make sure I have cash and capital available so when it all falls apart, I can take advantage of it. So yeah, set investment goals. Principle number 1. Principle number 2, understand your risk tolerance. So there are risk tolerance questionnaires that we give. I always joke and say we give these for the government. It's hard proof that we had a discussion.
That's right. That we had the discussion. We brought it up.
Yeah.
We made the client recognize that there is risk in investing and tried to get them to understand how they're going to react to that risk when it occurs.
Correct. And a risk tolerance questionnaire can help you do that, but really it's a discussion with your financial advisor and us understanding where the pain threshold is, and going through that questionnaire definitely helps us do that. Ultimately, really all you need is cash and something like the S&P 500, but for most people that's too nerve-wracking. So you have to work in bonds, treasuries into the portfolio to help offset the volatility of the stock market over the long term. 2022, that was an
aberration.
But yeah, understanding your risk tolerance. So how much risk are you willing to take? And in our risk questionnaire, people always go, how come in the questionnaire it asks how much money I'm going to invest? I was like, well, that's because it's not a fact finding thing. It's in there because it wants to make the questions relative to you. So if you put $100,000 in there, it's going to say, hey, what happens if you lost 20,000? But if you're investing $1 million and you lost 20,000, you'd be like, oh, who cares?
Right.
Well, but if you lost 200,000, right, that might be a totally different thing.
Well, we talk about this with clients in investing relative to the magnitude increases as the balances increase. The percentages remain the same.
Yeah.
That 20% that you're referring to is 20% on 100,000, is 20% on 1 million, but the magnitude is 10 times.
Correct.
Okay. And so it's understanding the magnitude of the volatility in the market and what it produces in terms of a gain or loss at any given time, and then how a client's going to react to that in an internal sense. Okay. Whether or not they're going to be comfortable with this, whether or not they are going to be able to withstand this, knowing or hoping we know that the market's going to come back at some point in time.
But does the market come back?
Historically, yes, it has always come back. And it's referred to as the market is just resting and pausing before it prepares to launch a new high at some point in time in the future.
So there's a couple of ways to think about this. One is you can invest your risk tolerance, which I think this is where the benefit of a financial advisor is, because a lot of times young people come in and they're conservative investors or moderate risk takers, yet they're probably leaving 3-4% on the table and on average rate of return per year for their next 25 years that they're working. But if they have someone they can call and talk to and help them understand why the market's doing what they're doing, what's happening in their portfolio, then they can see, they would stick with it.
Right.
Where if they took a higher risk tolerance on their own, and in our firm, your highest risk tolerance is like probably equal to the S&P 500. It's nothing like investing in Billy Bob's bait shop or losing all your money, in some crazy investment that no one's ever heard of. So that's the role of an advisor, is to help guide people through the rough times of investing.
Well, I think Vanguard put out some statistics on this a while back, didn't they? Where having an advisor is beneficial to a portfolio over an investment period.
3%
per year.
Yeah.
And the idea being is that as an advisor, we act as that guide, along that investment portfolio along with the financial plan.
Right.
And we're guiding the investor through these periods. It's like guiding through the darkness, at some point in time. And we're there at not just as a sounding board, but also as a understanding, the client and the risk and the financial plan and putting it all together, saying we're still in the zone of confidence that this is going to have a positive outcome.
Correct. Diversify, point 3, or principle 3, diversify your portfolio. So when I was doing workshops, I did for the Airline Pilots Association here in Atlanta. Pilots would walk up to me afterwards and say, "Look, I've diversified my portfolio." And at the time, the plan that I was advising on had 3 different large cap funds. There was an index, there was a value, and then there was a growth. And all actively, 2 actively managed, 1 passive, right? And it basically said they diversified by taking their money and dividing it by 3 and putting those categories, right? That's not diversification, because a lot of times, in the value and the growth, you ended up with the exact same stocks that are also in the S&P 500.
Which we call overlap.
Yeah.
Okay.
Correct.
All the managers are investing in the same companies.
Over the years here at Wiser, we've seen only a small handful, but people think that diversification has to do with the custodian.
Yes.
And I remember Matthews one time had a client that was with 30 different companies, because that was diversification, because someone told her you have to diversify who holds your money. And so she was in 30 companies, and these are larger companies, so they all basically had the exact same portfolios in 30 different places. And just the administration alone, the logins, the statements, like you couldn't even manage it. How do you do tax loss harvesting on 30 different accounts at the same time? You can't do it.
No.
And we're trying to explain to her that she could put everything at Schwab, Fidelity, TD Ameritrade, and there's what they call SPIC insurance. And if those companies went out of business, she's guaranteed to still own those stocks, right? And just could not grasp the concept. So we had to draft 30 different portfolios, 30 different custodians. Actually, it was probably more like 60-something portfolios, because each one had like an IRA or a Roth, right, or an individual brokerage account. That's not diversification.
No, that's not.
And there's no real risk.
We see this from time to time.
There's no real risk of a Schwab, TD, Fidelity going out of business and also taking your money with it. There's just zero risk with that. So that's not diversification. So ultimately, diversification is large cap, mid cap, small cap, foreign, bonds. Inside bonds, you have maturity or duration, the time of the bond matures. So 1 to 5 year, 5 to 10, 10 to 30, right? So those are your bonds. And you have high yield bonds, which we don't invest in. We have emerging market, they're your third world country bonds, which we don't invest in. But that is a diversification factor that some companies will deploy. So you want to just picture each one has its own risk number. So the risk number of a S&P 500, and I'm making this up in my head, from 0 to 10 is probably about a 5, maybe, right? Oh, well, okay, maybe 7. You say it a 7 out of 10? Emerging markets is 10.
Yes. If that was the boundary.
If that's the boundary.
Yes,
emerging markets 10.
Right.
Maybe the S&P 500 is, I give it a 6 now. Put U.S. treasuries down to a 1 and 2.
Right.
Right. Small mid-cap stocks are closer to 8. And so each one of those is your volatility, and then assigned to that volatility is a rate of return. So typically the higher the volatility, the higher the rate of return.
Right. Over a significant period.
Yes.
Over a full market cycle.
Not a 1 year period.
No.
10 years plus.
At least. Yeah.
So you build a portfolio by diversifying optimally in each one of those categories. And if you're doing individual stocks, you got to be carrying at least 16 stocks in different industries.
Right.
Not the same industry. 16 stocks in the tech sector is a tech portfolio. That's not a diversified portfolio. So if you look at last year, in 2022, the S&P 500 was down 18%, but energy was up over 60, right?
Mm-hmm.
So in a diversified portfolio, you would have participated in some of the energy increase.
Right. It held up other sectors.
But it was masked. It was masked by negative across the board in other places.
Well, energy only holds about a 6 to 7% weighting in the S&P 500 now.
That's
whereas
correct.
in 2011,
Yeah.
it was the largest weighting in the S&P 500. So
Got replaced by tech.
That's it did.
So that's diversifying a portfolio. And I don't think people understand what diversification means. I'm surprised I have to explain it on a podcast, but that's fine. That's what we're here. We're here to educate people. I had someone ask me last year that they were probably too old to be diversified, right? And I didn't even understand how the question related. Like, I mean, you're too old to diversify. It means that you had to put everything, all your eggs in one basket because you didn't save enough money. I don't understand. Everybody should be diversified. If anything, if you're young, you could maybe just place everything in the S&P 500, I guess.
But even that, 500 companies.
Yeah, true.
Yeah, it's still 500 companies.
That's still diversified.
It's a single asset class.
Yeah,
with 500 companies.
That's very true.
Yeah,
yeah, and I could actually get on board with that. Mm-hmm. You had a pretty good rate of return over the last 2 decades if you just had nothing but the S&P 500.
Right.
Yeah. All right, number 4, invest for the long term. You have some data on this, don't you?
Yeah, this is where it starts to get interesting. Okay, investing over the long term is actually a fascinating endeavor for an individual, I find.
Everyone says it, nobody does it.
I know it. That's part of it right there, is that having done it, now I can look back on having invested. My first investments were in 1990. It's even hard to say that anymore. Okay,
you were really young then.
I was old enough to have a few bucks to invest. That's all. But I was younger than I am now, for sure. But I've seen through investing the ups and downs of the marketplace and all the events that can and do occur that affect the stock market, the economy, and our investments. But do they have a permanent effect on it? No, it's always a temporary effect that where investors, it's not the market that reacts, it's in how investors react to the event that's occurring in the marketplace. Look, back in 2008, okay, this was during the great financial crisis. The financial markets actually froze up for about 4 days. Banks closed on an unprecedented period of 4 days. It was a weekend and 2 days aside from that. Lehman Brothers collapsed. It was one of the first financial firms that we've seen collapse in a generation or more. Okay?
Right.
That occurred. It brought on a decline in the market over a period of beginning in 2007, in October of 2007 through 2008 into March of 2009 of straight declines down. I think the stock S&P went down something like 52% at that point in time. On a chart today, it's a blip. Okay?
Right. Yeah, it was so dramatic.
It was so dramatic, but it came back beginning on March the 9th, 2009, and had an unprecedented move for years that had occurred. Okay. Then something else happened. And again, these are things that are out of most investors' complete control. You have absolutely no control over these events that occur, but they create chaos, which creates opportunity. I think in 2011, we had the U.S. debt being downgraded because they were, the administration and Congress, again, was arguing about the debt ceiling, or the budget, I think it was then. So the U.S.'s debt was downgraded. It didn't default, but it was downgraded. The stock market went down like thousands of points at that point in time. Okay, it just happened. But again, on a chart over a long period of time, it's just a blip. I mean, you can't even see these things.
The problem is it's human nature. So we live in this world where diesel prices are cheaper for maybe 3 months than gas. So everyone sells their gas car and goes out and buy a diesel car.
Right.
Or gas gets really expensive for 6 to 8 months, and then everyone sells their gas car and buys an electric car. And so we live in this, just human nature thinks that whatever we're going through, it's going to be this way forever. And that's never the case. It's only seasons.
Right.
And so when you are going through that, your emotions tell you, I've got to get off the ride. The ride's going to fall apart.
And if we do, and that's, every investor has the ability to do so in a liquid market. But for the person who stays in the market and invested $10,000 back in 2007 and let it ride for 20 years, they ended up with $35,000.
Yeah.
even through these ups and downs.
If you invested in 07, you're talking about like the high in 07?
That's another stat I've got here. The interesting thing about that, everybody's heard the story about if you miss the best days in the market, how much lower your return is.
Right.
We get asked all the time, Casey, and it's a normal question, is now a good time to invest? And we started out this podcast saying that this is a crazy time.
Yeah.
But does that mean it's not a good time to invest? It's always a good time to invest.
Right.
So let's take a look at some statistics around the person who may be the worst investor in history. Okay.
Who's this person?
Louis the Loser. Louis the Loser had the bad luck to invest every day for 20 years on the worst day of the year. The day, and then this chart is the Dow Jones Industrial Average at its peak each year. Invested $10,000 at the Dow Jones peak every year for 20 years.
Okay, so Louis the Loser, why would his parents name him that? That's so strange.
I don't know. This poor guy had the worst luck in the world.
So he invested at the highest for 20 years.
For 20 years.
Always bought at the high.
Always bought at the high, the highest day of the year. For some reason, so at the end...
He probably had no money.
Imagine that. I mean, to have that much bad luck, okay? So what was his return after 20 years? 20 years of investing $10,000 at the peak of the Dow Jones Industrial Average every year for 20 years. He invested a total of $200,000. At the end of 20 years, he had $1,157,000.
What's that an annualized rate of return?
15.7% annualized return.
15.
Right.
So
during this time period.
So buying at the high, you got a 15% rate of return.
Right.
What if you bought at the every low? Do you have that? I'll put you on the spot.
I do have it. Somebody else who invested on the low of the Dow Jones Industrials every year for 20 years, during the same time period, would have a 17.2% return.
So 2% per year difference in rate of return is fairly significant, compounded, but I'm surprised that it's only 2% difference on investing at highs versus investing at lows.
Exactly.
Interesting.
So is it a good time to invest?
It's always a good time to invest.
That's right, because it goes back to what we were saying. This is the country with the freest capital, the highest capitalistic approach to protecting capital, to investing capital, to using capital to expand their products and services in the economy.
What's the same between those two examples is dividends. So if your money sits in cash, you cannot collect any of those dividends that those companies pay.
That's correct.
So even if Louis is buying at the all-time high, if you went back and look at his rate of return, it's probably because of the income that he's receiving has a big part to do with it. Because even if you lose 18% in a year, like we did in 2022, you still would receive
the dividend.
Your dividend. And depending on your entry point, the yield could be anywhere from 2 to 4%, depending on when you bought the shares initially.
And when you are reinvesting those, you're buying more shares.
You're buying more shares.
At a lower price when the market goes down.
Which generates more income.
Which generates a larger dividend next time.
Yeah.
Yes.
That's the hidden part that nobody can do the math on.
Compounding.
They only look at price in their head. They don't think about the income that's being generated.
That's right. That's right.
So that's probably why it's different. But
I thought this one was unique and a good story to tell, that it's always a good time to invest. In fact, we'll dramatize it by saying picking the worst day of every year to invest and doing that. And what's the return versus having picked the best day of the year to invest.
You probably should have Louis on the podcast and ask him how he's able to perfectly choose the highest day.
He'd probably get lost on the way here.
Principle number 5, rebalance your portfolio regularly. I think this is really hard for the DIY investors. It requires Excel spreadsheets and all that fun stuff. Today we have fancy computers that do that for us. But it's interesting that that's principle number 5, because when you look at highest rate of return, it's really from the people who don't rebalance. They just let the winners ride, right? But I think that it does a couple things. I think one, it forces you to look at the portfolio and analyze, right? Mm-hmm. But ultimately, if you're in a 80% stock, 20% bonds, over time, the 80% stock's going to become 90 and the bonds are going to become 10.
Right.
So the reason why you want to rebalance is it keeps it within your risk tolerance.
Which goes back to
back to good behavior.
That's correct.
Yeah.
Okay. And understanding point number 2, understanding your risk tolerance.
Correct.
But what it also does is that it utilizes, really, when you're rebalancing, you're utilizing the principle of buying low and selling high. So when you're rebalancing, you're selling the highest valued assets in your portfolio.
That's true.
And reallocating them to the lower valued assets.
That's a really good point.
Selling high and buying low. So it's the reverse.
So in a 60-40 portfolio, which is most common for retirees now, 40% during COVID drop, that 40% went up by 7. So you took your 7% in gains and you then bought stocks, which were down 32% at one point. And then when that 7% was invested in a stock that's down 32 and it came back, that added 3% to the rate of return from that one rebalance.
Yes, it did. We did the calculation on that.
That's right. So that's another reason to rebalance. So that goes back to being greedy when others are fearful.
Yes. Warren Buffett saying.
Correct. A couple other principles to add. Do your research. So before you invest in anything, make sure you understand it. We've had a few people come in our doors over the years with these leveraged ETFs.
I was just going to bring that up. Yeah.
Yeah. Stay away from leverage, margin, ETFs that are doing 2x the S&P 500. Even financial advisors, especially the ones at the big brokerage houses, they don't understand these products. They've never actually read the prospectus like we have. Those are levered products that are being reset on a daily basis, and that's not something you want to mess with. You're not going to get, if the S&P does 8%, you're not going to get 16 because it resets daily. It's not annualized. So you'd have to hit every day just right to really do a 2x. It could be less, could be more theoretically, but it's almost always less. So do your research. Stay away from annuity products. That's another real killer for asset growth, especially the index annuities, which are big paydays for the advisor selling them.
Part of research is also cost.
Yeah, true.
Yes. And some of the products that you just mentioned are very high cost, high ticket, cost products.
Right.
Okay.
Right. Because when you go walk into a Wells, Edward Jones, or name any other place that is on all the street corners, their whole purpose is to sell or to sell product, generate revenue. And if they can get away with it, they're going to do it at the highest cost to you. Right,
because they're not fiduciaries. Okay?
No,
they follow required their suitability.
Right. It's much like mortgages. You might be suitable or qualified to have $1 million mortgage at the age of 65, but should you have $1 million mortgage? Most people have $1 million mortgage at the age of 65. No. No, but you could be qualified. You're qualified to buy this annuity. No one's going to get in trouble for selling you this annuity.
That's right.
Doesn't mean it's a good idea.
Whereas what we'll do is we'll look at products side by side, and all things being equal, we'll choose the one with the lower expenses.
Yep.
Right.
Don't panic sell. And this is the value of an advisor. Vanguard calls it advisor alpha. What value do we add to a relationship as portfolio managers? At our firm, we look at ourselves as we're financial planners first. We also do asset management, and that's where 90% of our revenues derive from, is doing asset management. But if you look at that management fee, I'd say 25% would be allocated toward research and portfolio management. The other 75% is really more allocated toward financial planning, which a lot of firms that do planning really only focus on retirement planning. They don't focus on anything else because they can't. There's no products to sell you to be able to offer other things. We don't sell any product, so it makes it easy for us to be financial planners first. But getting help from an advisor helps you put all this together and keep everything going down the right path. And if something gets off, you have a relationship with a firm that has a benchmark of where you're supposed to be, right? And then how do we get back to that path? Or maybe things have gotten better, and then what else can you do with your resources, right?
Exactly.
So yeah, those are additional principles, but I guess just to recap, set investment goals, understand your risk tolerance, diversify your portfolio, invest for the long term, and then rebalance your portfolio regularly are 5 principles of successful investing. Thanks for listening. We've got some other bonus features available on A Wiser Retirement, our podcast channel. We'll reference 2 of them here in our show notes. We have one video, 2-bucket investment strategy, income strategy versus total return. What's the number 1 rule in investing, right? That's a short little video we did. Also, take a look at our other podcast, episode 154, Investing Through Times of Fear. This episode's really going to apply, I think, for 2024, which I'm sure we'll rebuild that by the time we get to the election cycle. Designing your portfolio to leave a lasting legacy, episode 121. So much of how we manage assets is really similar to endowments and how they manage assets, right?
It is. We take an institutional approach,
and leaving a lasting legacy. You can do that through low cost indexing, the way we approach it. If you're interested in learning more about Wiser Wealth Management or want to schedule a consultation to meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com, or you can click on the link in the episode notes. Thanks, Brad. See you next
Casey.
week.
Good talk.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This episode was produced and edited by Ken Hoadley. This podcast is strictly for informational purposes only and is not to be considered as investment advice or a solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investment advisor with the SEC. The host and/or guest may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guest of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.